So it's an intermarket Wednesday. What does that mean? We're talking about the interrelationship between bonds, stocks, commodities, and currencies. So that will be a background theme into what we talked about today, even as we discuss some of these option flows, et cetera, that are going on. And so as we kind of examine, we'll talk about the 90 rubber band. We'll see what the volatility markets are doing as we go into today. Is it a jobs recession? Again, what is the impact that that's having on rate cut odds? We'll take a look at that. And we'll get to the console. We'll talk about gold and silver. What's the play there? I mean, they're very, very extended in the very near term. But you are seeing a little bit of a flip in the options market changing today, bullishly on those two. And we'll look at lottery tickets on Plug and QS. We took a lottery ticket trade earlier today on Plug in Ghost Prints because of this activity. I'll just show you kind of what happened or what's going on with those products. All right, so let's dig in here. So let's look at the volatility market. So we have a shutdown. And again, like I said yesterday, nobody expects the shutdown to really be impactful on the stock market, right? I mean, at the end of the day, the shutdown itself does not really mean anything. We don't need most of the services the government provides for the stock market to go forward. And so I've got SMCI up here, but let's look at SPX. And so by itself, it does nothing. Where you see the potential issues arise is the deal, right? So, maybe they wanted 1 trillion in certain spending for certain people under the Affordable Care Act, and we didn't get it. The Republicans need 7 members of the Senate to pass the bill. They're not getting it. They say they got 3 coming to their side. They're thinking they're going to might hold a vote today. We'll see, whatever, right? But the point is, does it matter if the government shuts down? The answer is no, right? We may not get a jobs report on Friday. Big deal, right? We got an ADP report today that was fairly negative at minus 32,000 jobs. I remember when Mark Zandi went to ADP and tried to change the models of ADP so it mimics the payroll numbers, and it's been terrible, right? ADP has been a terrible predictor of what the Friday jobs report is going to be. I mean, Mark Zandi, I don't know, he seems like a nice guy, but to be honest, I'm not sure he's very effective at what he does. But my point in this is just saying, look, I mean, what moves the market right now is certainly being fueled by the jobs number that came out today from ADP. And so we'll take a look at that. So as we look at the S&P, we're starting to post a positive on the day. So we're up about 0.1% right now. Healthcare is leading. Some of that drug, biotech news there, drug stocks. A lot of breadth yesterday. A lot of drug stocks getting bullish option activity. It's been surprisingly bullish for a while, but we're starting to see maybe the fruits of that. Just we're grinding it up, right? We're just continuing to go higher. I mean, stocks like Merck, for example. I mean, huge move the last 2 days. Supposedly on some of the weight loss drug stuff. So there's so much happening right now that's kind of news that's driving healthcare. Has not been UNH, right? It's not MDT, right? This is medical devices. What is it? It's drugs and biotechs. The PPH is the pharmaceutical ETF. Boom, boom, the last 2 days. So, I mean, clearly this has something very, very different that's driving pharma that's driving any other part of the market right now. So yes, if you jumped on board yesterday, it was worked out today. If you jumped on board a few days ago, despite the fact pharma has not been a pharmaceutical ETF has not been a leader. Healthcare has not been a leader, but the news has reversed things. We're seeing a big snapback in some of these stocks. We've been in RX, and that sucker just is laying down. We might be finally starting to see that perk up today. I've seen this to get up here towards 6 and we're good. But the idea is that, look, yes, we're getting some pharma move. We're getting some healthcare move, but really it's all comes down to pharma. Then you look at utilities. What's so bullish about utilities other than the fact that things aren't going well, right? Economically, it's a shelter play, right? It's a defensive play. We look at TLT, for example, this comes down to bonds, right? Bonds are selling off today. Why are we so excited about utilities other than, again, we're just basically saying we think the economy is weak. We're seeing some degree of rotation towards a defensive sector. This is not defensive, right? Anything that's moving healthcare right now is not defensive. If we look at XBI, for example, biotech, right? Biotech's been screaming the last few days. This is not a defensive area of the market. Healthcare as a sector is not a defensive sector. There are some areas that are a little bit more defensive, But XBI is as Momo as it gets. It's as pro-growth as it gets. There is no defensiveness in biotech. Like Johnny said, look, if borrowing costs for these companies are heavily leveraged, they have no revenue, like in RXRX, for example, yeah, look, low if bond yields go down, yes, borrowing costs can get a little bit better for them, right? Assuming what? Well, assuming that we don't see that we see HYG big drop today. So that was one of the things I talked about yesterday, right? Bearish interest in HYG, looking for something to crack here. So if we look at a lot of biotech, are borrowing costs going down today? The answer is no. Borrowing costs are going up. And if we look at HYG, again, they're going up even greater than what treasuries are going down, right? Going up in terms of yield. So we're seeing HYG selling off today. We're seeing LQD go down. Again, what is this about? We're seeing risk spreads widen right now, right? The perception of risk in companies are actually getting greater. And how can we look at this? HYG plus IEI. No, it's IEI. Sorry, it's SHY. HYG plus SHY. Well, notice up here, right? If I look at this ratio, we're seeing in the yellow line up here, what we're seeing is that, look, the spread right now between treasuries, so if I look at SHY, that's 1 to 3 year treasury bond ETF. HYG has a duration probably around 2. And so if I pair those together, what we're looking at is similar durations. I keep doing REI instead of SHY. Similar duration, similar effect is caused by changes in interest rates, but it's the quality that represents the difference. And right now we're seeing is that HYG, the amount of extra yield you pay to borrow as a junk bond issuer, guess what, is very minimal over treasuries. And again, yesterday's huge prints, bearish prints in HYG was basically looking for downside, a big move, maybe even a crash by October's expiration. And so we're seeing right now is this ratio is breaking down today, right? So HYG is underperforming a similar duration, similar maturity SHY. If we look at LQD, we compare it against IEI because the duration on LQD is more closely related to IEI's duration than SHY. Again, yields right now for companies to borrow are very, very low relative to treasuries. It's a very tight risk spread. The perception of risk in the bond market for corporate bonds is very minimal. And so the idea is that if the Fed cuts, and we're going to look at that here in a second, but if the Fed cuts, it's not necessarily meaning that corporations are going to see their borrowing costs go down. Because why? We might be cutting rates as we're entering recession. And with today's ADP report, again, jobs go negative when? Jobs are a coincident indicator. They're not a leading indicator. Weekly jobless claims can be. But when jobs go negative, it basically tells you you're in recession. And again, we'll see whether we get a jobs report this Friday or not. But right now, borrowing costs for companies are very, very low over where treasuries are. And I'm expecting those spreads to widen. And that's exactly what we talked about yesterday in HYG when we saw that these massive trades way the heck out of the money, basically saying, look, HYG is going to crash. Is it? No idea. Okay. So we look at the volatility markets today, right? So the S&P showing a little bit of green. We're seeing what? We saw a gap open in the VIX to 17.25. How much was the VIX actually down, S&P down today? Not a lot. We basically came close to yesterday's open, and yet the VIX gaps higher. Why? Again, there's the shutdown. We're entering a new quarter, right? We'll see whether we're going to see the deck reshuffle based on new expectations, a new quarter. Okay. Did I see a butterfly on JP on my screen? I did not. We can look at it. But again, the point is just that, look, I mean, a lot of stuff's happening beneath the surface. Skew ticked up a little bit yesterday. It's at about 143, but we're elevated, right? Institutions are very hedged in this environment, and they should be. There's a lot of weak data out right now, right? That's not good. Home price index down, 5 months in a row, right? Homes losing value. That's been a source of credit for retail, for investors, right? It's been a source for the consumers, right? To spend money, et cetera. So as we look at today, again, the bond space, we're seeing some selling in bonds. We're seeing borrowing costs go up, and that influence is being more impacted. The lower the credit quality you get, the higher your borrowing costs just went up today. Now, how does this reflect in the how does this reflect? Man, I'm having trouble talking today. How does this reflect in the interest rate markets in terms of expectations for rate cuts? So if we look at the October, which is right here, October, 99% probability that we go from 4 to 4.25 to 3, 7, 5, and 4. Yesterday was at 96. We had a slight probability of no rate cut. Now we're pretty firmly entrenched after the ADP number in getting a rate cut in the next. If we weren't already, we're pretty much there. A week ago, we're 91%. We're seeing a slight amount of movement towards rate cuts for the October statement. December, 86.9%. We get another 25 basis points. Yesterday, that was at 77. We are seeing a much bigger shift here, right? For between yesterday to today. So again, what's the cause of the shift? Why did we go from a 77% probability to an 87% probability of a rate cut in December? Anyone want to share that with us? What happened today that basically shifted 10 percentage points that we're going to get a rate cut in December from yesterday to today? What can we point to other than the fact we had an ADP jobs report that was negative? But the government shut down again. Could we lose jobs there? Absolutely. But I would point more to the ADP report being such a big surprise. Now let's take a look at the report. Notice right here, ADP posted a negative 32,000 jobs. They're trying to model, right? Mark Zandi years ago tried to change the calculation from what they report versus just give us your data versus saying, no, we're going to modify the data that we get through ADP to model it after what the government report, the NBR report. And if we look right now, again, what have we seen here? Right? We had a negative print in July. We have another negative print here in October. So government shutdown certainly could be influential, but the government shutdown would only be influential if we're really going to lay off 300,000 people, right? Is that actually going to happen? We'll see. They're talking the rhetoric that they want to cut costs. They're going to use this opportunity in a government shutdown because we're not offering a continuing resolution to continue the spending and appropriations for these things. We'll just cut them, right? Rather than furloughing, we'll just do the cuts because you didn't appropriate the funds for these, right? So the issue with layoffs has been you're not appropriating the funds. Well, guess what? You just did not pass the continuing resolution that would have appropriated the funds for these positions, and therefore we're going to cut them. We'll see if that happens or not. So could that affect the economy? 300,000 people getting laid off? Probably would, right? But again, we look at the jobs report today. I think it's just more indicative of the weakening in the jobs market really driving things today. And what we're seeing is that shift in rate cut odds for December. What about January? January, we're about to, so 3.5. What were we in December? 3.5, right? So January, we're starting to price in a 39% probability of another rate cut. It was 29 yesterday. So we're seeing the rate cut odds right now shift over a quarter point. Look at March. So 3.25, right? Now we're at 46. We're looking at what? 66% chance. We're looking at, basically a 66% probability that we're going to be at 3.25% by when? By March. January is what? 39% chance we're there. So now all of a sudden we're starting to price in more and more rate cuts, right? So we get to December, we get to 3.5. We're about a 50-50 probability that we cut another 40 probability we cut another point. But by March, we're now looking at a 60 over 60% probability that they're cutting in March another quarter point to 3.25. Again, did that shift? Yeah, a little bit. Now let's go to the end of the year. Let's go to December of next year. We're now looking at what? 26% chance, 28% chance. We're basically split 50-50 that we're going to be at 2.75% by the end of the next year. Well, that means a 1% cut in a 1 year period of time, right? That's pretty big. And so, what is that doing in terms of the market? Well, it's not really creating a significant inflationary response. If we look at TLT is down about 0.25% right now. Again, if this starts to see more like bigger selling in TLT, we are starting to price in more odds of that being inflationary. But why is the Fed cutting? Right? Why is the Fed cutting? It's because they think we're going into recession, right? I mean, that's really what it comes down to. But for the time being, we're saying we're not there yet. So the risk appetite is on today. Is that going to last and for how long? But today was probably one of the bigger days that I've seen where we are seeing some rotation towards risk. And that's kind of a big deal. So if I look at my GP industrials and technology list here, notice that the top two performing stocks on this list, when it kind of matriculates here, Plugs up 17% today, right? PLQS up 14%. This was up over 20% a little bit ago. Plugs experiencing a big move today. So what is driving these companies? What's driving QS? Well, we could look at the news on Plug and say, well, Plug Power just jumped 12%. Why? Well, apparently there's some hydrogen thing, right? Jabuez, the company said, delivers first 10 megawatt Gen Eco electrolyzer array to Galp, a Portuguese energy company. So we're delivering something, right? Hydrogen-based technology. We're delivering on something that we've already priced in. We knew that this was going to be a deliverable. Okay, we finally delivered. Okay, now we're up 21%. The stocks suddenly were 21% more just because they delivered something that was ordered a while ago? No. Why is Plug up today? Why are we seeing all this big push? Why are biotechnology stocks making such big moves? What is the key driver for all of these? Does anyone know? So let's throw out some stocks here. So I'm going to go to Yahoo. Throw out some stocks. So let me bring up Plug. Throw out some stocks that are making big moves right now. Okay, throw out some stocks that are making big moves right now. And let's take a look at this. So here's Plug Power. 31% of the float is shorted. Okay, think about that for a second. There's 100 and what? Float is 1.09 billion shares. This is a moderately high float stock. Okay, this is not a 40 million share float. This is a 1 billion float. And 31% of those shares are already sold and have to be bought back. This stock is not going to average 1 billion shares a day, right? So the short ratio is 8.89. It's massive. It's going to take about 9 days to cover Plug. Think about it for a second. 9 days to cover 358 million shares based on the average volume today. So not only do you see that's a massive number there on Plug, that's an even more massive number when you consider the number of days it's going to take to cover those shorts with a 1 billion float. The potential move in Plug is enormous. All right, let's look at REGN. Let's look at the stock first. And we're going to weigh the potential impact here. So REGN's up 7%. All right, now, what is the potential impact here? Again, is this just sympathetic movement? Or is there something that you could see a much, much bigger move in REGN? Let's take a look. So we're going to go back to Yahoo Finance. I'm going to type in REGN. Okay. Oops. Why does not go to statistics? Scroll down here. 2.9%, 7% of the float. Short ratio is 3 days. Is that high? No, it's not. Right? This is almost 100 million shares float. It's a moderate float stock. It's not a low float stock. It's not a high float stock. It's moderately low. And it only has 2.97%. So do you want to jump into REGN? Probably not. Right? What about Merck? Now Merck is a bigger cap company, right? So we go to statistics here. Merck is up what? 1.2%, 2.39. NVO. NVO. Short percent of float, 0.85%. 1.94 is the short ratio. Those three stocks do not have the same potential as some other companies. Now, it doesn't mean they can't go up. We have had some news, right? We have had some positive news in this area. So Novo Nordisk, we're getting some sympathetic movement, right? If we look at Merck's already had 2 big days. Why? We're repricing because of some of the news. Amgen, let's look at Amgen here. Amgen's up big, right? Now, I don't know what Amgen is now. I know what it was in the past. Let's look at Amgen here. What kind of short interest is in Amgen? 2.46, but notice the short ratio, 6.63. So there's only 13 million shares shorted of a 536 million float, but if there's any covering of those shares, the impact of that covering's higher. Do you see that? That short ratio says that, look, to buy back 13 million shares is going to impact the price. So what do we see, right? Higher short ratio, we're seeing greater impact on Amgen. All right, now let's go to the console here and let's see what we got today. I'll show you yesterday. So let's go yesterday. And we're going to look on the buy side here. So I'm going to take off the stuff that people are selling, options people are selling. And we're going to zero in on sector. Oops. And I'm going to uncheck all of them. We're going to focus on healthcare. Yesterday in healthcare, what did we see? So I believe we looked at this a little bit, but Merck, right? 2000 at the ask, right? Pfizer, right? Merck, Amgen, 287.50s, right? Pfizer. So we're looking at these companies, AbbVie, right? Did it go down this list right here? The puts are on CVS, they're on Walgreens, they're on Merck to put in there on the 80s, for example, but we see a lot more bullish ones in there. We got to put on Pfizer, Merck, and Pfizer in here, but we're seeing very decidedly bias on the call side for most of these. And you'll see some of the volume on Pfizer, 36,000 contracts yesterday. Merck, 12,000 contracts, right? These are on the buy side. They're most all of them are calls. So what can create movement? I'm talking about short interest, but guess what else can? You buy calls on stocks, guess what happens? This is what can happen. This may not be much of a short squeeze, but it can be something that's called a gamma squeeze. Has anyone ever heard that term before? What is a gamma squeeze? Does anyone know? Tim's heard of it. What is a gamma squeeze? So think about this for a second. We go back and we say, okay, yesterday, we're seeing big time call buying in many of these drug stock names, right? We're looking right here, Pfizer. We started out about 7,000 when this alert triggered. We scaled up to 36,000 contracts for the 3 October 26 calls. So let's go in and take a look. So we'll go this week's expiration, 26 calls on Pfizer. Oops, wrong one. So we come in here, Pfizer. So we're going to look at the 3 October expiration right here. Okay. 36,000 at 29. Was that right? Make sure. Sorry, 26. So 26 strike right here. Of the 30,000 contracts were traded, 20,000 spilled over and was retained at 26. We're going to look at a chart here of this. And we're going to see that the last 2 days, you're seeing what? There was no volume until when? Yesterday. What is this called? I call it a squeeze bar, right? You see all of that volume jump in at that strike price yesterday. And I'm remiss that I didn't do a trade on Pfizer. We were in RXRX. We already had a lotto trade on it. Didn't do it. But we had over 30,000 contracts. And guess what? There was no trade. There was no volume in this before, right? Virtually all of that lasted through today and 20,500. Now we're seeing 31,000 contracts traded. We go to the 2750s, there's 20,000 contracts traded at the 2750 today. So if we go back to and we look at Yahoo Finance and we say, okay, well, what was the short interest on Pfizer? It wasn't very high. It's not the shorts, right? Short percent's 2%, short ratio is 2.85. This can impact the 112 million shares can be bought back. But how many shares have we seen today? So let's just focus on the stock here. How many shares traded yesterday? Yesterday, it traded 164 million shares. All of the short interest could have covered yesterday. There was enough volume that traded on Pfizer, they could have covered all their shares. This is not a short squeeze. This is what you call a gamma squeeze. And we kind of hit it. We saw this yesterday as I showed kind of I think I showed it during my session yesterday, might have been during the mastermind, but I thought we showed during my session all of the calls that were traded in biotech and drug names. Most of them are big drug companies like Pfizer, like Merck, okay, like BMY, Bristol Myers. So what are we seeing today? What is pushing these stocks? It's called a gamma squeeze. So what happens when you see 20,000 calls being bought? So yesterday we had 37,000, 20,000 carried over to today. Who's taking the other side when we have a very imbalanced trade? So let's come down here. We're going to look at today's option statistics. 44% traded at the ask versus the bid. Might have even been more imbalanced yesterday, 4.5 times the average. But if somebody's buying 30,000 contracts of an option, who's taking the other side of that trade? Does anyone know? Who's taking the other? So if you want to buy 10,000 contracts right now in Pfizer, who's taking the other side of the trade? Kristen says the market maker. Yes, the market maker is. So the market makers are suddenly short a bunch of calls. That's a bearish trade, by the way, because someone came with a bunch of institutions went in there, bought thousands of calls. The market makers short a bunch of calls, and we have a positive news cycle. Ken Griffin, we have a positive news cycle. What do you have to do as a market maker? So suddenly you're short, you're negative a bunch of delta on out of the money calls, and those out of the money calls can instantly go in the money. So yesterday, again, 26, stock price is up $1.57 today. And look, I mean, 26 was out of the money yesterday, right? It might have been down here at the time. Now we're at 27.05. Hedge with long stock. Yes. Right? The price was down here and suddenly you're short a bunch of calls and they go from like a 20 delta to an 85 delta. Okay. This is what you call a gamma squeeze. And the problem is they're kind of stuck there, aren't they? So what's propelling the stock right now? Yes, the news created the interest. But what's propelling Pfizer? And we can look at, again, we go back to our list here on Ghost Prince from yes, BMY, right? Amgen, Merck, Lilly, right? So let's go through the list here. Are you seeing a distinction in the performance of those stocks here? Lilly up another big move today. Merck is up another big move, right? BMY, Bristol Myers, another big move today. So what we're seeing is that yesterday's activity, yes, we saw big moves in these stocks, but if we look at some of these other ones, right, they're not moving as much. Why? Why didn't Regeneron get such a big move yesterday and today? Well, we can talk about today. Why did it not move yesterday and suddenly moving today? Didn't move yesterday because what do we know about yesterday? Regeneron was not one of the companies that they were buying options in. Now the question is, are they buying them today? So let's change this to today's move, right? And we'll focus on the sector. We'll focus on biotech again, right? So scroll down here. We'll focus on healthcare rather. Where are we seeing today's activity? We want to look at what? We want to look at call buying, not call selling. And we want to go side. We want to focus on the call side. Where are we seeing activity in in the healthcare space today. Most active: Pfizer, Lilly, Pfizer, Hims, BMY, NTLA. I think I saw Gianni talking about NTLA, I think a minute ago. NTLA kind of pop, and we're kind of fading until therapeutic. Again, just go through this list, right? Today, where are we seeing Nova Nvax, right? NVAX. Novavax is making a bit. Why didn't it make a move yesterday? Why is it happening today? So let's go back to this, right? Craig says, then how do you choose which ones to trade? Got to make a decision, right? You can try to get in the right space, but luckily for that, I mean, every single one of those moved, didn't it? Okay. So yeah, we're taking one on plug today. We had one on RXRX. RXRX did not get any call activity yesterday, right? Didn't. So yeah, sometimes you pick the wrong one. Now, here's the deal though. What if you said, look, I'm gonna risk a certain amount of capital and you just trade multiple underlines? But if you go back to yesterday, you could have traded any single one of those. Again, Pfizer, right? Lilly. You could have traded Merck, right? Every single one of those, BMY, every single one of those would have worked out. So just so happened yesterday, because of the news and the option activity, and it was the option activity that was driving the price mostly, right? But again, why is Novavax moving today and not yesterday? In part because we're seeing what? There's call activity in Novavax today, right? And there is an element that the rising tide lifts all ships. But notice that there's a lot more breadth today. OCGN. There's a lot more breadth to this trade going on, isn't there? Okay. Now, how can you kind of break it down further? Well, Novavax. What would make Novavax maybe more interesting than another stock like an OCGN? So let's look at NVAX here on Yahoo Finance. We'll come down here. Short interest is 27.6% and 6.4 days. Yeah, Regeneron was on the list, right? So again, there's an element rising tide. We're seeing money just indiscriminately flow in. But you need to make a decision as a trader. Can you buy every biotech stock? I mean, think about this for a second, right? So how many stock trades can you have going at one time? How many stock trades can you reasonably trade at one time? Think about this for a second. How many stock trades can you take at any given time? 10 to 20, right? I mean, are you going to really trade more than 20 stocks? And even as a long-term investor? No. Right? I mean, if you're only going to buy 10 to 20 stocks, are they all going to be in biotech? No. Right? I mean, you don't want to be out there buying 50, 60, 70 companies just because you can't just pass up on something, right? It's unreasonable to hold a significant number of holdings. Right? You're not going to hold 10 biotech stocks. You got to make a decision. Which one are you realistically going to trade? Right? Because you can't buy everything. So if I'm looking at this, I'm saying, well, all right, I got to make a decision here. Right? What's the decision I need to make? Well, which one of these stocks today? So let's say I wasn't in biotech yesterday. I'm not in today. Well, which one of these am I going to choose? Understanding that really what drove stocks yesterday was the news. But the news fueled what? A gamma squeeze, right? You have all these call options being bought, and all of those stocks that saw the heavy option activity were the ones that outperformed yesterday and then going into today on a relative basis. So now what? Okay, maybe I missed those. Well, then I'm looking right here and I'm saying, well, Novavax has a short ratio of 6.4 days. This is a moderately high float stock at 136 million. And guess what? The short ratio is 6.4 days. It's going to take 6 days to cover 44 million shares of Novavax. So if I'm saying, look, I want to hop in and speculate, which one do you speculate on? Because you can't buy every one of them, right? Am I being realistic here? Can you buy 10 biotech companies? Is that wise? Do you just say, look, I'm just going to put 50% of my portfolio into these 10 stocks today? Is that a wise decision? Probably not. Daniel says, I own 12. Okay, now here's the deal though. How much of your portfolio should be in biotech? I mean, I guess if you said, look, I'm going to put 10% of my 10% of my portfolio into pharmaceutical companies, and some will be pharma, some will be biotech, right? And you said, I'm just going to take smaller positions and break it up. But Dan says, I was already in them. So the issue is that, again, do we want to be that out of balance? Probably not. You just can't buy every stock out there and hoping just that it's just going to. So at that point, you're basically saying, I don't know what I'm doing. I don't know what I'm buying. I'm just going to buy everything because I can't make a decision. So at some point, I mean, as a trader, and yes, sometimes your decisions will be wrong because you picked one and a different one moved, right? That happens. So the idea being is that if we look right here, and again, we're just looking right here, and I'm saying, okay, if I'm looking at biotech today, and I felt like I missed it a little bit, but I want something that has greater squeeze potential, not just from the options market, but the idea that the gamma squeeze, forcing market makers to buy stock to hedge, and then driving the shorts to cover. Novavax seems to be like a pretty decent setup today, right? Novavax seems to be like a pretty decent setup today. Where could this go? Well, let's take a look at it more closely. Let's go to studies. I'm going to load my auto expected move, and we're going to load in here. We're going to edit studies. We're going to put in a 3 standard deviation move. So I'm going to edit properties. I'm going to scroll down here. We're going to put 3. Say okay. We're going to say okay. A 3 standard deviation move. Now, looking back in the past, how frequently? Now, here's the deal though. These lines should contain 99.7% of all price if they're priced efficiently. Okay? If this is priced efficiently, it should contain 99.7% of all price. Notice what's happened here, right? So right here, we blew through 3 times the expected move. Right here, we blew through 3 times the expected move. Here we touched 3 times the expected move. Right? Here we touched 3 times the expected move. Here we touched 3 times the expected move, right? Here we went through 3 times the expected move. And right here is just a really wide burst. So we have what? We have 1, 2, 3, 4, 4, and 5. So over the last year, there's only 52 occurrences, right? About 10% of the time over the last year, we've touched 3 times the expected move. So would you say that the options are relatively cheap or expensive on Novavax? I'm glad I'm answering there. Okay. So cheap, right? They cannot price the options on this stock. And if we look at implied volatility right now, where is it on Novavax? We're at the 38th percentile, right? So not only that, we've gone to 3 times the expected move, 5 times, almost 10% of the time in the last year. The implied volatility is in the lower 38th percentile. The high is 147. The lower is 48. We're currently at 86. So 86% is actually low. Let me see. I might have another study here too. IV percent rank. Nah, that's what I wanted. Sorry. I gotta find my study for that. So what do you do here? So if we look at Novavax, we're saying, okay, do you buy stock in Novavax? Because realize that this thing's made 3 standard deviation moves to the downside as well. So this stock could be at $9.43 today. It could be at $7 tomorrow. Okay, great. So Daniel, perfect. You got 20%, and you're saying, okay, hey, I'm outsized pharma. That's okay. Because it's okay to be imbalanced a little bit as a trader. Most hedge fund managers are imbalanced. They own like 10 companies and they might have 30, 40, 50% in one stock. Those are hedge funds, right? Like your Bill Ackmans of the world, that kind of thing. So the idea is that, again, you just got 50% cash. All right, great. I can weather the storm a little bit, right? Market corrects 50%. Okay, maybe lose 25, maybe lose 30, right? Okay, I'm with you. So for Novavax, you buy stock in Novavax? Hard to control risk, right? I mean, could this thing squeeze the 15? Absolutely could, right? I mean, and that the degree of short interest in Novavax is that big. Okay, it's that big. So, but it can also drop 50% in a couple of days, right? So we got this two-edged sword. In statistical terms, it's also called we have skew and we also have kurtosis. There's heavy kurtosis in these stocks, but the option volatility is not pricing it in fully. So let's go out in November. Well, what do you do? Well, I mean, look, do you have to buy Novavax shares? You could go out 51 days here and look, the 10 strike price has 90% vol. The 12 strike price has 95% vol. The 13.98, 102 at 14 at $15, 104% vol. You could buy a 10 and sell a 15 in here for how much? That 15 strike has 24 cents out there, doesn't it? You could buy that for 79 cents. You risk 79 cents to make what? 421. And you've got 51 days for this squeeze to happen to go to 15. But your break even's at 1079. Well, if you buy the stock right now, what's your break even? So if you buy, and I got to pass the ball here. I didn't quite get my agenda. I got excited about biotech, but so think about this for a second. If you buy the stock today, what's your break even? So you buy the stock right now, what's your break even? Then no, it's 944. You buy this, but how much you have to risk to take it at 945, 44? Prior lows right there at 810. So you buy 944, 810's there, give it some measure below that. I mean, even if you said, look, my stop's at that low, you can't risk 10% on this. Can't risk 5%. Right? So the reality is you're going to have to risk about what? Probably around 20% to take Novavax. 20% of 945, you got to risk about $1.80, $1.90. But your break even is 945, but your break even when you consider the risk, right? I mean, you need a move here. But the spread is you're only going to risk 80 cents now. Your break even is now 1080, but you've got upside to 10 to 15 bucks. What are your thoughts on that? I mean, to me, that's buying stock in Novavax tough. Buying a spread, taking advantage of the hedges, all the shorts hedging is exactly where it's at. So you got to be careful buying stock, right? In these kind of companies, because fat tails, this thing can crash. It can crash upward. It can crash downward. It's skewed though, that the bias is for an upside crash. That's exactly what we've seen over the last year. But we still have crash risk to the downside. A 3 standard deviation move is a possibility. $6 in a couple of days is absolutely on the table. Okay, tall text, but you're taking all the risk. You're just getting no premium out here, right? Against the stock at $9, you're getting 25 cents, 27 cents. So you may as well not just buy the stock, right? There's nothing out here that really is enticing to sell. And we already know that the options are too cheap for the movement. And so yeah, these are tough ones to even want to sell premium on unless you're taking advantage of the skew, which is heavily in your favor in Novavax. Well, folks, I got to wrap it up, pass it to Blake. I hope this has been helpful. So I was going to talk a little biotech. We just ended up going this direction entirely for the session, but I hope this was helpful in this discussion and really kind of helps you leverage what we do in Ghost Prints for these kinds of trades. Because again, there's been trickling in of option activity in biotech, and yesterday in pharma, but yesterday was the flood, and we saw the difference in the companies that saw the flows and that didn't. And now we're seeing carry-on flows and stuff like Novavax. Now we got the double your pleasure. We got the squeeze bar, gamma squeeze, or short squeeze. So we're going to do another session on that, a masterclass on October 10th. So if you want to join me, sign up for Ghost Prince. Anyway, sorry, Blake, a little over.
You are okay. I couldn't find my mute button.